Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, and good evening. Welcome to another episode of The Debt Doctor. I'm Bill Bymel, and thanks for listening. Today we're going to have a conversation about the secondary market. Now, specifically when I speak, I usually like to say the secondary mortgage market. But later on, I'm going to get into why I dropped the mortgage. I wrote a book about my adventures in the secondary mortgage market. It's called Win-Win Revolution, an insider's guide to investing in the secondary mortgage market. It came out in 2017, and it's a lot about what we talk about here on our podcast, which is borrowers in distressed debt situations, and how we worked to help thousands of Americans save their homes, and we made quite a bit of profit for our investors in doing so. It's the secondary mortgage market is where debt gets sold. So just to take a step back, it's not Vons. It's not Whole Foods. It's not even an official organization. The secondary mortgage market is a reference to an opaque, loosely connected group of people that just happen to know each other. That might be organizations like loan broker organizations, such as auction houses like DebtX or Mission Capital or First Financial Network. And then it could be smaller brokers that really cover the whole industry as well, like Citus AMC or SN's Trading or Rams Loan Trading. And then there's banks themselves and private banks and private equity firms that have trading desks. Cantor Fitzgerald, Bank of America, JP Morgan, all of the major players in finance have what they call trading desks for secondary assets. They look like a trading desk when you go into their Wall Street offices or wherever they are, Greenwich, Connecticut, or Dallas, Texas. They look like a trading desk you might expect to see guys trading stocks on or bonds or something like that. But really what these guys do is they trade loans. They trade derivatives of loans. They trade pools of loans. They trade participations in pools of loans, and they trade in these bonds, or often called securitizations, which are their opportunity to take a piece of hundreds, if not thousands, of loans, and what they consider to be a pretty secure investment. The secondary mortgage market historically is what dominated secondary assets. It was a way for banks and lenders, originators of loans, to get new money in their coffers in order to make new loans. It's one of the things I talk about quite often, in not only in the book but throughout my history, is that the industry of home ownership, the relatively low interest rates that Americans see comparative to the rest of the world, and the ability to borrow at relatively high loan to value on real estate is all because of the secondary mortgage market. It all comes from this non-existent opaque market that banks and lenders and pension funds and insurance companies can go buy a big pool of mortgages, put 100 million or 500 million or $1 billion of cash to work on fixed rate mortgages or government backed mortgages or private mortgages, much might be at a higher yield. Well, the secondary mortgage market is where all that stuff is traded. Like I said, it's not necessarily like me going onto a website. As a matter of fact, many have and still have Newmark and others. They have tried Real Insight. They try to have their own little online markets, and everyone's it's a free for all. It's who you know. And there's been periods of time prior to the GFC of 2008 where the secondary mortgage market really became more open to guys like me, regular real estate guys who didn't come from a Ivy League or a Wall Street background, who knew real estate but never thought of the idea of trading in loans as a way to get access to real estate. And when I got that phone call as a real estate investor at the time in 2008, 3 months before the fall of Lehman Brothers, I got a phone call from a guy who had bought some loans. Some, I say 3,000 of them. He was bidding on thousands of loans in a pool that was being sold on the secondary mortgage market after a bank failure. And for me, that was like a light bulb moment. Why? Because, wow, this is like a totally like small good old boys network, and to have access to it is really puts me a leg up. It's a high barrier to entry to get access to be able to bid on mortgage loans. Banks don't just let you call up and bid on them. It's the debt market in and of itself. Lending has to have a degree of separation between the lender investor class and the borrower class. And so, in order to be part of that investor lender class and getting access to that, you can either do one of two things. You can buy loans, and maybe you get access to the secondary market through a broker or somebody introduces you to it, or you can originate loans. And then eventually, when you run out of money, guess what? You're going to the secondary market to sell those loans. Now, 2008 to 2014, it was wonderful because we were buying mortgages anywhere from first lien mortgages where you really control the real estate. It's a very safe investment that you have to be paid off before a property can get sold or any other liens besides taxes get paid. So we were buying these first lien mortgages way back when in the early days, it was 25, 28, 35 cents on the dollar for first lien mortgages because the real estate was dropping in value. We needed a cushion. There was no liquidity in the market. By 2012, it was up to 60, 70%. And it kind of settled there. I would say that in recent years, it kind of got even crazier where, in places like Texas or California, went back to the old ways where NPL was trading for full debt, especially government-backed NPL. And we've seen it become very difficult for guys who seek opportunity in that owner occupied market to really find deals the last couple of years. We've had to go out and look at more of like non-owner occupied and RTL commercial non-performing as a way to find better yield. But that all things do come to an end. So, the next time every time a liquidity crisis happens, and we've had a few bumps along the way, I will say that is where opportunity in the secondary mortgage market really kicks up. Because I'll give you a couple examples. Performing loan pools in the months of COVID, after the beginning of COVID. So we're talking like COVID shutdown happened in March, late March, right? Early April. People were settling into home life. They were going online. By May, there was a real lack of liquidity and a real uncertainty in the market. This is 2020. I'm talking COVID 2020. There were loan sales that had to happen. So there were lenders or banks or that had to sell portfolios, and they ended up selling performing portfolios that would normally trade for the the price of the debt. Those portfolios ended up trading for about 6 months for they ended up trading for like 80 cents on the dollar. So like a 20% discount. So now the buyer of those portfolios, my firm happened to take part in a little bit of that. The buyer of those portfolios that might have bought a pool of, let's say $100 million worth of loans at a 7% average coupon or a 6% coupon. If I get that at a discount, now all of a sudden I'm getting 7, 8, 9, 8% on my money. And that's just unlevered. But the real home run came when the market came back in later that year, and we were able to resell those same pools at 95, 96 cents. So the secondary market, if you have a lot of cash to play with and you understand the market and you know how to do your due diligence, you know how to price things, all of that can really benefit you. It's a necessity in order to play correctly. But it opens up some really exciting opportunity. There's been so many times where I've picked up on things that the seller of the loan didn't even know existed. A near-term payoff or whatever. Real arbitrage opportunities for those that do their due diligence. Now, what does that look like? Let me just take you through the process of how the market works. In general, the market follows whether it's a negotiated trade, meaning a trade where a banker or a seller or a lender calls me up and says, "Hey, I got a pool of loans I want to show you," or it's an auction trade, or it's a brokered trade. In any of those circumstances, seller is putting this tape out on the market. It is a data tape that includes property addresses. It might include FICO score, credit scores of borrowers. It includes pay histories. It includes the property values. It includes the origination date. All the details necessary about the mortgage is what we call a data tape. And when they put that out there, they'll say, okay, here's the tape. We're looking for either an all or nothing bid, or you can we want bidding loan level. You can choose to bid a carve, or you must bid all of it. And then you ask for a date certain when they make this bid. And when we've been on the buying side of this, we're on the buying side of this all the time. So switching to the buying side, once I've made a bid, and if I'm awarded that bid, if I'm the winning bidder, I then start about a 30 to 45-day due diligence process. In the case of performing loans, especially if you're dealing stuff that is more conforming, it's like, government backed, whatever it might be, that process might be shorter. It may be 2, 3 weeks. We get a couple weeks to review the collateral, confirm the data that was on the tape is accurate, confirm that the collateral is properly done, finalize your contract, and you close within 30 days. And whether it's a $10 million trade, a $1 million trade, or $100 million trade, it all kind of follows that suit. You got to know how to navigate that world. You got to know what to look for in each loan file, and especially now that we're getting into commercial, it becomes a lot about the borrower themselves. Yeah, are they able to modify? What options are we going to, what are we going to face when we deal with this? But the reason secondary mortgage market is even more interesting is the secondary market. And that's really where, right now, most people investing in residential mortgages see it as a pretty risk off, only because there's so much equity, at least on paper, built into the residential real estate market. So as long as you're not doing something kind of out of the box or unique, which we'll talk about in a moment, then the mortgage market is kind of like, well, it's kind of like, it's kind of like the boring thing to do. It's kind of like, okay, you can get so much yield, everyone wants to be there, blah blah blah. Well, what has happened in recent years, and I would say even more so just in the last few years since 2020, 2021, is we have seen an explosion of other types of secondary mortgage market asset trades. Meaning, we're starting to see complex derivatives, or what they're calling them bonds, that back, maybe that like pool a ton of credit card debt, which is not secured debt, remember, non-secured debt, or maybe it's student loans, or maybe it's dental office loans, or manufacturing loans to against that are given against the collateral, like the machinery in a building. Well, all of that has popped up and has become all the rage in the last few years. And then even more, and on the real estate side, more trickier, unique, riskier, by what I see, and certainly more convoluted from a legal and documentary standpoint, more difficult to unwind. In the real estate side, there's been groups out there creating, what they call home equity loans, right? So they're equity conversion loans that are based on people signing over title to the property, where the lender becomes a partner in the future upside in the property, the future appreciation of the property. Just stuff that is above even my pay grade to understand. And I read legal documents. I went to school for this. I do nothing but real estate. But there are derivative programs out there that are being masked as safe real estate plays that are not. But I'm not gonna call those guys out today, because I'm going to talk about the opportunity that exists in the secondary mortgage market. Going back to all of those things, all of those additional, all of those additional new asset-backed securities that are being sold and traded through this secondary market. I want to point you to an article in the Wall Street Journal. So if you get a chance, go look it up. It was posted in February 28th of this year, just a few months ago. And the article is entitled, "They Crashed the Economy in 2008. Now They're Back and Bigger Than Ever." And then the subtitle to that is, "Wall Street expects to sell more than 335 billion in asset-backed debt this year." Remember that conference in The Big Short? It just drew a record 10,000. I chuckle because I talk about that. That's the SFIG conference. I talk about that conference. I go to that conference every year, and I have mentioned on previous on stage in conversation. If you've been an audio, if you've watched the or listened to my real estate lowdown or watched one of my webinars, I have mentioned that conference from The Big Short, and it is where kind of it was quite interesting um, to see this year the huge number. That was 10,000 registered at the conference. And I would say for every one registered, there's two or three that just come and sit in the lobby or hang out by the pool and go to the parties. And it was big this year. It was big and crazy. And it was big and crazy to the extent that there was a whole new generation of young bankers and young private equity guys who, by the way, if you were 35, now, as a young, hot banker or private equity guy, you were in high school, middle school when the GFC hit, when the great financial crisis turned this economy upside down. Because, oh, guess what? Because guys in your same room were giving out risky loans and selling them to Wall Street retail customers who gobbled them up, made them give out more of these loans. Sound familiar? A lot of that's been going on. I mean, think about the buy now, pay later firms. There's no collateral there. If all of us who had bought a Peloton or a dishwasher with a firm, we all get that offer. I think I actually bought my Peloton with in a firm just to test it out, and I paid it off. But all of those assets that people are buying with that type of debt, it's supposedly collateralized, but has a firm or any of these groups ever had to come and try and collect on a dishwasher that hasn't been paid for, or on a refrigerator, or on a exercise machine? That is 100% loss for people that stop paying. So if the borrowers start defaulting at higher rates, how is that a safe investment? How is that safe debt? So I'm going to leave you to read the article about how they crashed the economy in the Wall Street Journal. Again, February 28th, 2025. They crashed the economy in 2008. Now they're back and bigger than ever. It's not much to it other than pointing out what's going on and kind of giving some history. But somebody did it. The Wall Street staff asked the writer to, in a Q&A later on the website, a couple days later, which I will read to you. And the question was, well, if asset-backed debt was linked to the credit crisis back in 2008, why is it popular again? And the answer is that at 10,000 people, it was the biggest SFIG conference ever. And that is, this is one that was famous for The Big Short. Bigger even than like 2006, 2007, when mortgage bonds were selling like crazy before, they brought the financial system down. Now, at that time, the mortgage bonds had become the risky ones because they were selling so many of them. They were just giving the money away, kind of like a buy now pay later firm does, where you just have to sign for it. I'm hearing stories all the time now on the medical side with women who go in to their plastic surgery. They don't even have to have their credit pulled, and they'll get 50,000, 25,000 of instant credit with plastic surgery. And that's debt that has to be repaid. It goes, people are going to hunt you down for it, all of that. And that, by the way, that debt is being securitized now on Wall Street. That's right. Debt on face jobs and plastic surgery and Botox that is being offered directly from the medical doctors through the doctors. These are being offered through a program. It's a bond-based program where Wall Street is securitizing that debt and selling it off. You don't think that's risky? Financiers are once again creating and selling securities backed by now everything. The more creative, the better, in fact. There's corporate loans, consumer credit card debt is being securitized, lease payments on cars are being securitized, airplanes, golf carts, leases and purchases, payments to data centers are being securitized. The industry was once dominated by bonds only by home mortgages, but deals now reach into nearly every cranny of the economy. Today, big investors want to buy these types of securities because they think they are relatively safe and yield more than government-backed bonds. Banks are mostly middlemen because regulations instituted after 2008 curtailed their lending, and that opened the way for giant fund management companies like KKR, Apollo, and Ares to muscle in and make loans with their own capital. There's a lot more to be said there. I think the reason I'm bringing this up is I'm not saying that market is going to crash the economy. I'm saying that market is going to feel the pain of an already crashing economy, an economy that's now, and when I say crashing, it is a hyperbole. We're not on dire straits yet. Maybe by the time this episode comes out, things will be looking worse, but we're very volatile this year in 2025. There's a very high chance that we'll see market corrections in some area, whether it's stocks, bonds, whether it's a huge devaluation in things like art and jewelry, or whether you finally see the realization of the commercial real estate market having already gone through a devaluation by way of the rise of interest rates, and maybe just not a realization of that by the banks. Maybe we start to see bank failures. But anyway you cut it, there's going to be value in opportunity if you go in buying the right product. See, now I see a lot of risk in the secondary market when I look at the kind of stuff that's been sold recently. I would never buy a security on credit card debt, or a security on on makeup debt, or a security on what else? On golf carts or airplanes. I mean, if the economy does go sideways in any way whatsoever, the first thing people are going to stop paying is the luxury stuff. And the opportunity now, I see value if you're buying the right thing. If you go in, I'm a capital preservation guy first and then look to arbitrage yield thereafter. But if you go in looking at it from, okay, first lien mortgages on real estate, where real estate doesn't, you can pretty much track, so that if you are buying something at enough of a discount, if you're buying it, you know, 60 cents, 70 cents on the dollar in today's value, you're pretty safe, even if it means you have to sell it quick just to make a quick profit. It's also a great place to find opportunities and access to real estate in a market that has been very difficult to buy in. I mean, a lot of the huge inventory, a lot of the price jumps and the huge jumps in values, that the bubble, we can call it a bubble, that has happened in certain areas, especially in residential, where you've seen like 30% increases in the last 2-3 years. A lot of that comes from a lack of inventory. And that lack of inventory, well, there's a whole nother world of that, right? There's government intervention, shutting down foreclosures and evictions. The government won't foreclose on government non-performing loans. The money that the government put in people's pockets, the extend and pretend that banks have done with a whole myriad of loans, whether it's real estate or other types of C&I debt, commercial, industrial debt, whatnot. But there may be some storm on the horizon, and when the storms come and the markets start to in there, and liquidity has already dried up, we know that. That's when there's opportunity, because that's when even the good quality assets, the first lien mortgages on quality real estate, then they all get lumped into, oh shoot, there's this bad secondary market. Well, how do we know that from a derivative? Well, I know the difference. And that's where the value is. That's when it's time to really hit the home run. There's been 2 periods in my life where huge amounts of money and huge opportunities for a broad number of this American population has existed, that opportunity to make a lot of money. The first one was post the savings and loans crisis of the late 1980s. It spawned what we called the Resolution Trust Corporation, where the government took in all of these performing, non-performing mortgages on commercial and mostly commercial, some residential real estate all over the country. And that was the RTC ended up auctioning off properties to the highest bidder. And I have plenty of friends who bought 1 or 2 properties or a lot, but I know several self-made multi-millionaires who got their start buying in the RTC. And then there's the GFC, the Great Financial Crisis, the 2008, the meltdown of private equity, the failure of Bear Stearns, the failure of Lehman Brothers. By the way, on the record, don't be surprised. I'm going on the record saying there's another private equity firm out there today that's could face what Bear Stearns and Lehman, those guys faced. Thank God they're not banks. Well, let's hope that they're not banks. But there are some private equity firms out there that have gotten out over their skis. You will mark my words, that will happen. There will be failures. And so the opportunity lies ahead, folks. I hope you find some interest in this conversation. If you liked what you hear, please subscribe and listen to more episodes of the Debt Doctor. We're going to have a lot of amazing guests on the show. People that trade loans, people that buy loans, people that have bought loans outside of real estate. And we'll talk about the impact, and we'll continue to talk about that market, because the liquidity in that market, or lack thereof, brings opportunity. That second time that I talk about that GFC opportunity, when we were buying mortgages on brand new houses in Port St. Lucie, Florida, in the late 2008, where we paid 28 cents for a mortgage on a brand new house. I mean, the value is obvious, and that opportunity will come again. Thanks for listening. Have a great day. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.